By the way, this video is recorded in English, but we have a Filipino version which is posted on our website. Please visit our website, taxcall.ca. Then on our website, just click on Tax Tips, and in there a series of videos on different topics about personal tax and other financial matters, including investments, insurance, and many others. These videos are practical in nature and are truly beneficial to you. Feel free to explore our website and enjoy watching our videos. So our topic for today is all about recession. So what is recession? Recession is the continuous fall of the economy for straight 6 months. It normally occurs when there is a negative disruption to the balance of supply and demand. If there is a mismatch as to how many people want to buy and how many products and services are available in the market, once there is an imbalance, it may trigger recession. So how do we determine if there is an imbalance? It is normally reflected on the relationship between inflation and interest rates. Inflation happens when there is an increase in the prices of goods and services. But inflation in general is not really a bad thing. In fact, low inflation rate helps the economy because it promotes growth to different businesses. But high inflation, which is not backed up with high demands, is actually bad for the economy, which may lead to recession. Interest rate, on the other hand, is the cost of borrowing. Low interest rate means many companies can borrow money for expansion, including ordinary citizens can benefit from low interest rates. They can take big loans such as mortgage and car loans. But when the interest rates becomes too high, it might trigger recession as well. So fluctuations on interest rates and inflation can give us an indication as to the status of the economy. So what are the causes of these fluctuations? The most common are socioeconomic disruptions such as war, disaster, calamity, and now we can add on the list global pandemic. For example, the most common commodity that almost everyone is dependent upon is oil. If there is disruption to the supply of the oil, which will increase the prices of the oil, it will also result to the increase in prices of common commodities and services, because every industry, either commerce, transportation, manufacturing, service-oriented business such as healthcare, are all dependent on oil. Then if the inflation continues to increase, normally the government will also intervene by increasing the prime rate or interest rate. That is to control the spending habit of the consumers and at the same time encourage also investing. Because by increasing the interest rate, it will also increase interest on savings account and short-term investing. Increasing interest rates may help maintain the balance, but if the economy will continue to go down, such action is only temporary and will cause a domino effect to the economy. So let me show you how increasing interest rate will eventually lead to financial crisis. If the interest rate will continue to go up, it will then penalize the companies and businesses who have too much debt, because now they have to pay higher interest on their loans. It will also impact homeowners who have large mortgage and some individuals with personal loans such as car loan, because they will now pay higher monthly payments. So most companies will cut down their costs by reducing production, shut down production plants, close some offices, and in the process, many employees will lose their jobs. So now it resulted to much bigger problem. The consumers will now have lesser money to spend, which will lead to foreclosures of their homes and personal bankruptcies. So if the economy will continue to spiral down for straight 6 months, then it is officially at recession. So if Bank of America will announce that they are now at recession, actually the drop of the market started 6 months ago. And the effect of the recession may take up to 1 year before the economy starts to stabilize. So how the cycle of recession unfolds in the stock market? The economic drivers of the stock market are the super rich and the wealthy. They have vast of money that are invested to different business sectors, different countries, and demographics. So when they release their investments to the market, and those companies who receive those investments will also utilize them for expansion to promote more growth. And that growth will continue to stabilize. Then the next group of people who will notice the growth are the online traders, or what we call stock watchers. I myself is an online trader. As the growth continues, the public consumers will then join the ride because they feel confident joining the market as they respond to positive reviews from media, TV reports, and feedback from their friends. But such gain will only be temporary. As many people are joining the stock market, eventually the market will saturate. And once those investors are happy and satisfied with their growth and with any indication of possible disruptions which will result to the investors losing confidence in the market, then they will start leaving the market, taking home the ultimate gain from their investments. Then the traders will be the next group that will notice this trend. Online traders, just like myself, will then start pulling out our investments because the charts are now showing indication of possible decline. So the consumers will be left behind with the losses. Then when the market would hit rock bottom, the investors will then go back and start the cycle, followed by the online traders, and then the public consumers will join at last. And the same cycle repeats over and over again. The investors will go in, followed by the traders. The public will always join the last, and the investors will go out with their gain, followed by the traders, and the public will always be the victim. Public consumers are always the victim of recession, which is why I normally advise my clients, you have to be proactive in your investments, not reactive. You have to respond to the market before the fall, just what the investors and the traders are doing. So who are considered as public consumers? Those who buy stocks from the banks, or buying stocks from brokers or online apps, or those who are buying cryptocurrencies. In short, these are the people who are self-managing their investments without a concrete knowledge or training on market investing, also known as DIY or do-it-yourself investing. If you own mutual funds but lacks a technical knowledge of investment market, that is also very risky. Actually, a lot of people don't understand what mutual fund is. If you own mutual funds, then you are still part of the stock market. Mutual fund is a form of investment in which the money of all investors are combined together and managed by a fund manager. The most common fund managers are from the banks and other fund companies. The fund managers buys and sells stocks on your behalf. So if those stocks will grow in value, your investments will also grow. But if the market is bad and the stocks within the fund suffered a loss, then your investments will also suffer a loss. Always remember, the financial industry is a big money game. So since it is a game, there are rules to follow. If you know the rules, then you have high chance of winning. But if you don't, most likely you'll be part of the losers. Just like any other game, in order for you to win, you need a coach. In the financial industry, your active advisor serves as your coach. So if you don't have an actual coach, how will you win? I always hear from people saying that they have financial advisors in the bank. But if you examine closely, are they actually your active advisor or your customer service representative? There are what we call bank advisors, but most of the time they only act as customer service. They only give you advice if you come to them. You really have to book an appointment and take a day off just to talk about your investments. But what if you can't visit the branch? What will happen to your investments? Even insurance agents, many of them are not really actual advisors. They act as sales agents. In the past 5 years, our market has experienced several fluctuations, several ups and downs. If none of your insurance agents had advised you or given you updates on your investment, meaning they just did their jobs as sales agents. After they sold you the product, they just waited for you to call them again for the next purchase. So who really are active advisors? Those who have vested interest on your investments. Independent brokers like myself have vested interest on your money because we are paid by commission. We actually receive two types of commission, upfront commission and trail commission. When you invest, the investment company will give us upfront commission. Then every year, they will accumulate all the investments that I handle, and I receive a certain percentage on that, which is called trail commission. So if all the investments under my watch grow in value, then my trail commission is also bigger. But if I let your investment suffer a massive loss, then my trail commission is also lesser. So your success with your investments is also a success in my business. But if you compare it with your bank advisors, they are bank employees which earn a salary. Whether your investment makes money or lose, they are still going to receive the same per hour salary. So your bank advisors, their boss is the bank. While with independent brokers, our clients are my boss. You are my boss. Active advisors should give you regular updates on your investments. In fact, just a week ago, I had already informed my clients about my observation of the market, giving them time to act quickly in this declining market. How about you? Aside from this video, Does anybody actually inform you about the latest market trend? If not, maybe it's about time for you to decide whether to seek another active advisor. Well, I am available at your service if you want. Active advisor should also help you in fund switches. What do you mean fund switches? When the market is good and have better opportunity for growth, you should position your investments to a much aggressive portfolio. But when the market becomes shaky just like now, then you should be able to move your investments quickly to conservative. If no one is advising you, how will you do that? If not, then you will surely lose the money game. And lastly, active advisors should be able to explain to you the complexity of the financial industry. And that's what my clients have been complaining all along when they visit their banks. The bank advisors are using very technical terms that are too complex. While me, just like in this video, I normally dissect every information so as my clients can digest properly the knowledge which I am trying to relay. So let us take a quick look of what has happened in the market recently. Since I consider myself as an online trader or a stock watcher, barchart.com is actually a good source of information for stock market. For US market, I normally looked at S&P 500. If you're not familiar with S&P 500, that is actually the top 500 companies of US. So most of the companies that we know like Facebook, Apple, Tesla, Microsoft, and many others are part of S&P 500. So S&P 500 is a good indicator of the US economy. In the last 10 years, US have grown to 223%. That is an average of 22% per year. So if your investments did not grow by at least 20% every year, then it is a loss of opportunity for you. Another reason for you to look for another advisor that can possibly help you position your investments properly. So for US, if you notice, there was a big drop in the market when COVID happens, way back in 2020. But after that, the economy just grew too fast. And now we actually see the start of a decline. But the growth that we experienced in the past 2 years was not because US economy is doing better, but simply because US Federal Reserve printed extra money worth trillions of dollars as financial aid during pandemic. That printing of money actually triggers high inflation. Why? Because people now have money to buy, but most business actually control their production. So there is now an imbalance between supply and demand. Remember the imbalance that I mentioned before? That any imbalance can actually trigger recession? Exactly the same thing as happened in Canada. In Canada, I normally looked at TSX 60, meaning Toronto Stock Exchange top 60 companies. Canadian market has actually grown 184% for the past 20 years. So that is actually an average of 9.25% every year. So again, if your investment is not growing 9%, meaning you're losing opportunity of your investments. Just like the US market, the Canadian market also suffered a loss on the onset of pandemic, but after that, you can actually see a massive growth. Again, that growth is not because Canadian economy is getting better, but that's because Canadian government has released billions of dollars as financial aid. So just like what happened to US, the growth of the stock market is not the growth of the economy, but mainly because of inflation. Unlike US, Canada has not shown any decline yet, but I believe the market will saturate anytime soon. This is actually a big warning sign, a bait for everyone to join the market. If you had not joined when the market dropped last 2020 and just decide to join the market now, you will probably end up like the public consumers in my early example. You will be the victim of the market. So be thankful to me that you actually watched this video and have been warned in advance. Investing is basically like planting. You should know when to plant and you should know when to harvest. Now is not the best time to plant. Now is actually the best time to harvest. So let's examine if we now have possible indicators for a recession. First, disaster. Of course, COVID is a global disaster. High gas prices, yes. High inflation, of course, our common commodities now have almost tripled in prices. Increase in interest rate. Bank of Canada and Bank of America weeks ago just announced that they are increasing their interest rates. And lastly, loss of jobs. Can I possibly predict when will be the next recession? Of course not. But if this economy will continue to go down for the next 6 months, then we're possibly gonna go into recession. So we have to watch the market carefully. But before I end this video, there are actually ways for us to prepare for recession. Number one, protect your finances. Make sure that your financial situation won't be heavily impacted on recession. Use recession as opportunity, not at the mercy of its effect. So you have to think like investors, not as consumers. First, eliminate high interest debt, because as inflation continues to increase, the Banks of Canada and Banks of America will also increase the interest rates. If you have high interest debts, it will have major impact on your finances. Second, build emergency fund, at least 3 to 6 months of your income, so that when the market falls and in case you lose your job, financially you'll be okay. And third, create multiple income streams. Now is actually the best time for you to think as to the possible source of income in case you lose your main job. Well, let me tell you, financial industry is one of the most lucrative source of income. I have experienced it myself. Since the last recession, I've always been depending on my income from the financial industry. If you want to find out more how to earn money from the financial industry, it's not just insurance. Let me tell you, that's one of the most common mistake of people. They thought that if you are an insurance agent, you only sell life insurance. There's so many income streams in the financial industry through the insurance industry. If you want to find out more about it, please feel free to reach out. Number 2 ways of preparing yourself from recession is do not invest anymore 100% in speculative investing. What do you mean speculative investing? Keep away from pure equity such as stocks. Again, as I mentioned before, now is the best time to harvest, not plant. Keep away from cryptocurrencies. Yeah, you may still participate in stock market and cryptocurrencies, but not 100% of your money. But as investor, you should keep good cash flow ready for reinvesting. The worst thing that can happen to you as a possible investor is when the market crash, that's actually the perfect time to buy stocks, because prices are ridiculously low. But if you have no cash, then how can you join? Stock market crashes is very rare. You only have a very small window to act and join. And the third way to prepare yourself from recession, control your emotion. Sometimes news and media can cause hysteria. Market crash should not be scary. In fact, it is actually exciting and the best time to invest. Me as an investor, I'm actually waiting for the next recession because I know exactly what's going to happen next during recession. Once it hit rock bottom, there's only one way, and that is going up. Because actually, nowadays, I'm not sure if the market can sustain its growth. So I tried to be more conservative with my investments. So thank you very much for watching this video. And if you want to discuss more about possible market trends, my information is on your screen. Feel free to reach out and we can discuss more about it. Again, if none of your advisors have talked to you about this subject matter, I highly recommend switch to another advisor. Just like any other physician, if your doctor is not helping you to have good health, so what prevents you from switching to another doctor? Thank you so much and have a great day.